All right, so we are on section 3 of chapter 1, but before I talk any more about that, I just want to do a super quick review. You guys can look back at this video at any time to look at this, so if there's something you don't remember, don't be afraid to look back or use your books. But again, don't forget about these transaction rules. If it increases the left side, and increases the right side, decrease left side, decrease right side. If it's on the same side, then one account's increased and one's decreased, all right? So that would be buying supplies with cash. They're both assets. The other one is the accounting equation always has to remain in balance, and the accounting equation, again, is assets equals liabilities plus owner's equity. And there will always be two accounts that are affected, all right? So I'm going to move on. And this is the cheat slide that I gave you when we talked about buying supplies on account, receiving cash, paying cash for a couple different things. All right, now I've got another cheat slide that's going to talk. This is what's going to be in section 3 of chapter 1. We're going to be talking about receiving cash, sales on account, paying cash for expenses, receiving cash on account, and paying cash to the owner. This is how the accounts are going to be affected. So don't be afraid to look back on this screen. Again, it's a cheat screen so that you know what to do as far as do I increase or decrease. You'll have to figure out what accounts, but at least you know what's going on. So this is just kind of an introduction here to what we're going to be doing with 1-3. So I'm going to go straight to 1-3. And the very first thing we're going to talk about is, obviously as a business, we want to make money. And how do we make money? Well, we make sales, all right? So remember that this business that they're using these instructions on is Techno, and she is a sole proprietor who does some technology work with networks and stuff like that, okay? So she has to make sales. And the first transaction is going to it says that we received cash from sales. So she did some networking work or helped somebody with their computer stuff. When she got done, she gave them a bill and they paid her. So she has revenue now. So we're going to increase cash, and then we're going to come over here to owner's equity. Kim Park Capital is her name. And we have just now increased our capital, which again is our what we have invested in our company. So we increased cash, but now we have more to our company. So that's why we're going to increase each of these sides. And we're going to put revenue in parentheses to show that that's what that $295 was. Okay? Now, here's the other way that we're going to get business, or we're going to earn money. We are going to sell services on account. So what that means is let's say Kim Park for Techno, let's say she does all of our tech work for Central City. So what happens is throughout the month, we say, can you come in and do this work and blah, 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 blah. She comes in about 4 or 5 times in a month. Then, but rather than us paying her every time she comes in, what she's going to do is she's going to make an accounts receivable account. And this could be Central City, accounts receivable Central City. And what happens is that every time she comes in, she just says, here's my bill next week, and we keep track. And so she's doing work, but she's going to be paid later. So if she comes in this week to Central City and does some work, she actually has to show that she's getting revenue, but we are not paying our cash. We're going to pay it later. So she did $350 of work. So the transaction says sold services on account to Oakdale School. So she came in and worked one day, earned $350, but Oakdale's going to wait and pay later. But you have to show that you're earning that revenue now. All right. So we have a new account called accounts receivable. think of it this way. We receive cash. So eventually this is going to turn into cash. So accounts receivables are assets because we receive the money eventually. Whereas accounts payable are liabilities because that's money that we owe. So think about accounts payable, pay. We have to pay that. That's a liability. An asset is something we own. We own this cash. We just don't have it right now. But we have to show that we made that transaction. You have to show that the transaction happens, that you received cash. So this is also revenue, even though we haven't technically earned our revenue. All right, so on account, we're receiving on account. And again, you add the numbers up and the right side equals the left side. Okay. The next transaction we have are we paid cash for rent. These are expense transactions. Expenses are what it costs, the daily amount that it costs to run your business. It's what you have to pay to run your business. So these are just a couple examples. We have to pay rent. Okay, so we're going to pay cash for rent, $300. So I'm going to subtract it out of cash. And then I'm going to come over here to capital because now we have $300 less equity in our business. So we have to show that as a decrease. And then we put expense, just for now, we're going to do this, not forever, but for now we're putting what this $300 represents. It's an expense. Same thing down here. On the 12th, we paid cash for the telephone bill. Okay, so we're going to come over here and we're going to lose $40 in cash because we have to pay our bill. And then we're going to come over here and again, we have less equity in our business because we had to pay that $40 for our phone bill. So we're doing this these transactions just like we did 1-2. After you have a balance, you subtract out, then you bring down the new balance. If these accounts have not been affected, you just keep bringing down the balances. And again, after these two, there's two accounts that are affected. Notice we decreased this side and this side, so our accounting equation should equal. All right, couple other different transactions that you're gonna see for 1-3. We are going to now, Oakdale has said it's time to pay our bill to Techno. So Techno is the this is the transaction. So on August 18th, you receive cash on account from Oakdale School, $200. Okay, so now here's the thing. This accounts receivable, they owed us $350. Now they're paying $200, so you're going to subtract. And now we are getting our cash. So this is going to be increased and the accounts receivable is decreased. Again, accounts receivable and accounts payable are just basically accounts where we can just keep track of money we owe and money that we should be getting. The cash account's the one that's going to be affected. We're either eventually going to be paying that cash or receiving it. All right, so received cash on account. We know when we receive cash, we're going to increase cash, and now it's going to decrease Oakdale School. We don't do anything with capital because we've already have increased our capital when we made this initial sale. All right, so capital is not affected in that one. All right, and then here we go. We got paid cash to the owner for personal use. All right, so you're the owner. You can take out money from your business to pay yourself, but you have to put it in as a transaction. You can't just go to the cash register or whatever and take out the money. You have to actually write out a transaction, paid cash to the owner for personal use, and then put the amount. All right, so what it's going to look like is you're going to go to cash and you're going to take out $125. So you're taking out $125 of your cash. Then you have to come over here to your capital and you're actually going to decrease your capital by that amount because now you have less equity because you took it out. You took that cash out for yourself. So you still have to show that as a reflection over here in your owner's equity. You actually have less equity. But you got the cash. So notice what we did to this side, decreased it, we also did to this side. And again, after each transaction, we're keeping track of our balances. And then if it's not affected, we're bringing it down, and we're always adding up the assets to get a total, and we're always adding up the liabilities and owner's equity to get totals, and our accounting equation should always equal. Okay, so that was pretty fast. But we receive cash from sales. All right, we make a sale. Then we make a sale on account. A sale on account is going to be accounts receivable. And again, we have to reflect that we are earning that money, but we're not receiving it. So we're going to increase our owner's equity, and we're going to increase accounts receivable. Okay, paying cash for expenses. This is how we run our business. So obviously we're paying cash, so it's going to show a decrease. And then receiving cash on account. Now that goes along with this sale on account. We already reflected that we've increased our equity by making that sale. Now down here, we're going to show that we're actually getting the cash now, and we're decreasing our accounts receivable. And then down here is going to be paying our cash to our owner. All right, so let me get out of this, and let's go to this is going to be your next assignment, and I did a couple for you. So the first transaction is going to be pay cash for rent. And I did this wrong. I don't even know what I was looking at. I might have to make a couple edits on this. Okay, I must have been looking at something different, but we'll just change this. Okay, so we paid cash for rent $300. So I know that I'm going to decrease right here for cash. Anytime you hear pay cash, decrease. And I know now that that's going to affect my capital. So I'm going to come over here and I'm going to put minus 300, and I'm going to put an E for expense. I just want you guys to show me what this number is if it's in the capital column. Okay, so then I bring down my balances. Okay, and we bring down our balances, and then I don't know what I was looking at here, but our next one says that we paid cash to the owner for personal use, and it says $150. I do not know where I got these numbers, but it says $150. Okay, so pay cash to the owner for personal use. All right, I'm going to make this be $325. I'm going to subtract out that I'm paying cash, and then I'm going to come over here, and I am going to show that this is also a decrease in capital because I'm taking out money, I have less equity. And I'm putting a W because it was a withdrawal. Now when you do something with revenue, then you're going to put an R. So you're going to be using E, W, or R for any number that you put over here in the capital account, all right? So 650 is right. That's the right balance there. 200, 300, 375. And I think this is the right. I just, for some reason, I had the wrong numbers, but I think our balances are right. Okay, so this is going to be very similar to 1-2, and you're going to go ahead and do this, and then I'm going to add in another assignment. You're going to do it's called the Mastery Problem 1-4, and it's kind of putting everything together that we've learned, all right? So I'm going to let you go at it. And make sure if you have questions and you don't understand that you send me an email, and I potentially can meet with you to try to answer any questions, okay? The biggest thing is at the end, add up your assets, add up your liabilities and owner's equity, and your accounting equation should equal if you've done everything right, okay?